Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Schneider National Inc. Annual Report. Schneider National Inc. offers a wide range of transportation and logistics services across the United States, Canada, and Mexico. The company operates in three main segments: truckload, intermodal, and logistics. The truckload segment provides over-the-road freight transportation services through various types of trailers, including dry van, bulk, temperature-controlled, and flatbed. This service is offered either on a dedicated or network configuration basis. In addition to truckload services, Schneider National's intermodal segment offers door-to-door container on flat car services that combine rail and dray transportation using company-owned containers, chassis, and trucks. The logistics segment provides asset-light freight brokerage, supply chain, warehousing, and import/export services to manage and move customers' freight. This includes leasing equipment such as trucks to owner-operators and providing insurance to drivers and owner-operators. Overall, Schneider National's diverse range of services makes it a comprehensive transportation and logistics solutions provider for its customers. The recent surge in Schneider National Inc.'s SNDR stock price can be attributed to several key factors. The successful integration of Cowan Systems, LLC, which was acquired in December 2024, has been a significant driver of growth. This acquisition led to a 22% gain in dedicated freight volume and contributed to a 9% rise in truckload revenues. Schneider's strategic shift towards more stable revenue streams has also garnered positive attention from analysts, with Raymond James upgrading its stock rating. The company's management has indicated plans for further acquisitions to expand its dedicated trucking business, which has bolstered investor confidence. In addition to these developments, Schneider National has taken steps to return value to shareholders, including a 5% increase in quarterly dividend and the approval of a new $150 million share repurchase program. The company's progress in fuel efficiency and zero-emission initiatives has also enhanced its reputation and appeal to a broader investor base. While there have been some minor setbacks, such as a slight miss on earnings expectations, the overall positive sentiment driven by these factors has contributed to the stock's appreciation over the past year. As a result, Schneider National's stock price has increased by a little over 11.97% in the past year. Schneider National Inc. market capitalization of $5 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Schneider National Inc. holds a significant advantage in their industry. Schneider National Inc. trades at a higher price-to-earnings ratio of 50 times and a higher price-to-book ratio of 1.7 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company maintains a moderate leverage profile, with liabilities making up 39% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be categorized into several key areas. On the growth side, acquisitions and customer base expansion are significant contributors to increased revenues. The addition of complementary services and transportation revenue also play a crucial role in driving growth. Furthermore, the combination of unaudited pro forma operating revenues and logistics management revenue contribute to overall revenue increases. On the decline side, decreases in trade accounts receivable and allowance for doubtful accounts, as well as goodwill impairment charges and amortization expense for intangible assets, all contribute to reduced revenues. Additionally, a decrease in guaranteed residual lease values also impacts revenue negatively. External factors such as fuel price increases, inflation, and interest rate changes can have both positive and negative effects on revenue growth or decline. For instance, historically, fuel price increases have been recovered through fuel surcharges, which has helped mitigate the impact of rising costs. However, if not managed properly, these external factors can lead to decreased revenues. In terms of segment-specific drivers, the truckload segment saw significant revenue growth in 2025, driven by increased dedicated, van network, and bulk services. The intermodal segment also experienced growth, with increases in both revenue, excluding fuel surcharge, and fuel surcharge revenue. In contrast, the logistics segment's revenue growth was more modest, with a relatively small increase in fuel surcharge revenue. The net income of the company experienced a significant decline between 2024 and 2025. The decrease was attributed to various factors, including intense price competition, loss of major customers, difficulty in attracting and retaining qualified drivers, and potential unionization efforts. Additionally, operating inefficiencies from previous mergers, strategic investments, and interest rate risk on variable rate indebtedness also contributed to the decline. The profit margins of the company also witnessed a decrease during this period. The operating ratio increased by 0.1 percentage points, but the adjusted operating ratio decreased by 0.2 percentage points. Furthermore, the net profit margin dropped from 2.21% in 2024 to 1.83% in 2025. This decline was largely due to reduced freight rates to gain business, increased driver compensation, higher labor costs from potential unionization, and increased regulatory requirements, compliance costs, and potential litigation liabilities. The reasons behind the changes in net income and profit margins are complex and multifaceted. The company's dependence on third-party capacity providers, severe weather, climate, and similar events also had a negative impact on its financial performance. Moreover, impairment of goodwill, other intangible assets, internal use software, or long-lived assets further contributed to the decline in net income. Overall, the changes in net income and profit margins reflect the challenges faced by the company in 2025. The decline in these key financial metrics highlights the need for the company to address its operational inefficiencies, manage its costs effectively, and adapt to changing market conditions. The company's financial performance is a testament to its ability to generate positive operating cash flow. As evident from the provided data, the company has consistently demonstrated an increase in operating cash flow over the past year. In 2024, the company generated $686,100,000 in operating cash flow, which rose to $637,400,000 in 2025. Furthermore, the free cash flow, which is a more accurate indicator of a company's ability to generate cash from its operations, also shows an increase over the past year. In 2024, the company generated $305,800,000 in free cash flow, which rose to $348,200,000 in 2025. This upward trend in operating and free cash flow is a clear indication that the company is generating positive operating cash flow. The consistent increase in these key financial metrics suggests that the company's operations are becoming more efficient and profitable over time. The company's performance varied across different segments and regions. On the positive side, the truckload segment saw an increase in volume and revenue, while also improving its rate per loaded mile. The intermodal segment experienced similar growth, with increased volume and revenue. The dedicated segment performed exceptionally well, with a 23% rise in volume and higher revenue per truck per week. The network segment showed mixed results, with improved rates per loaded mile, but decreased volume and slightly lower revenue per truck per week. In contrast, the logistics segment struggled, with reduced volume within brokerage partially offset by increased revenue from the Cowan acquisition. The corporate and other segment also underperformed, with a loss of $28.8 million from operations. Management is emphasizing a customer-centric strategy that focuses on delivering high-quality experiences through integrated transportation solutions. To achieve this, they aim to grow organically, expand specialty services, improve operations and margins, and prioritize profitability and stakeholder considerations. The company plans to allocate capital strategically, maximizing returns while pursuing growth opportunities. This will be achieved by prioritizing return on capital discipline and long-term strategic priorities. Additionally, management is committed to creating differentiated experiences for drivers and associates to attract and retain top talent. In terms of investment, the company expects net capital expenditures to range from $400 million to $450 million in 2026, with a focus on growth and replacement equipment. Management also believes that their financial statements accurately reflect the company's financial position and results of operations. The company's strategic equity investments, including PSI and MLSI, have not resulted in any impairments over the past 2 years. Furthermore, substantially, all of the company's revenues and assets are generated within the U.S., with the CEO using income from operations to assess segment performance and make strategic decisions. The company has made several acquisitions and divestitures in recent periods to grow and expand its business offerings. In terms of acquisitions, the company has completed several deals without providing specific details. However, one notable acquisition is that of M&M, which was acquired for a total of $260,400,000 in assets and $243,800,000 in net assets. The exact nature and purpose of these other acquisitions are not specified. On the divestiture side, the company has sold substantially all of its assets, subject to approval by 60% of its capital stockholders. This transaction is also shrouded in mystery, with no further details provided about the sale or its implications for the company's operations and future prospects. The company has a history of paying dividends to its shareholders. As stated in the annual reports, it is their policy to pay quarterly cash dividends to holders of both Class A and Class B common stock. The dividend amount has remained consistent at $0.38 per share for 2024 and 2025, with a slight decrease to $0.36 in 2023. In addition to paying dividends, the company has also been actively buying back shares from its shareholders. Over the past 3 years, they have repurchased a significant number of shares, totaling $284 billion in 2023 alone. The cost of these share buybacks has ranged from $66.9 million in 2023 to $14.6 million in 2025, indicating a decrease in the amount spent on buying back shares over time. Supply chain disruption concerns loom large. The extracted summaries reveal several potential risks that could disrupt supply chains, impacting operations and results. Labor disputes or strikes at Class I railroads, page 13, pose a significant threat to intermodal services, while issues with third-party capacity providers, page 15, can lead to volatility in operations. Additionally, severe weather and climate events can also harm operations. Market conditions are another area of concern, as shifting market dynamics, cargo theft, and changes in volume and mix can all impact results, page 28. Furthermore, remaining performance obligations for transportation and logistics management services, page 60, may not be recognized until after 1 year, adding to the uncertainty. These concerns highlight the potential risks facing supply chains and operations. That concludes the financial summary for Schneider National Inc. Feel free to comment below, and I will be happy to answer them when possible.